Okay, well, welcome back to Accounting 7101. Everyone have a good weekend? Okay, yeah. Anyone do any study in the accounting? Yes, oh, very good. Me too. Okay, so this week's actually very important. So what I'd like, if anyone is getting lost or falling behind, doesn't understand, certainly put your hand up and let me know, because there's a lot of material I'll teach you today, and also this material is very important for the next few weeks. So it provides the foundation of a lot of accounting, and the material, it builds on itself as well. So it's progressive in the sense that it's difficult to understand if you don't understand the earlier material, the material today. So what we're going to look at is an account. And then we're going to look at some accounting transactions and events. And so we're going to go back to our accounting equation: assets equals liabilities plus equity. And this time we're going to introduce the idea of debits and credits. And then we're going to follow the process of recording accounting information. So we're going to take an event or a transaction, we're going to convert it into a journal entry, and then we're going to combine our journal entries and put some information into ledgers. And then after the ledgers, we'll be in a position to produce a trial balance, which sets us up for producing financial statements. So we're going to travel a long way today. So what we mean by an account, it's just an individual accounting record of increases and decreases in a particular accounting item, such as an asset, a liability, equity, income or expense items. With the names of accounts, some of them are sort of obvious, others are not so. So it generally gets a bit easier with a bit of practice. So certainly attend the tutorials and then get some practice using the accounting names. Some of the names are a bit flexible, but most of them aren't, so we'll need to try and remember the names of accounting items. So what we mean by transactions, so generally an event or a transaction, there's an exchange of something of value between two parties. And it's often involving assets and liabilities and equity, or could be income and expenses. And there's a couple of examples there is where an asset increases in price, or we're allocating the cost of a long-lived asset. So that's actually, we'll cover that later on, that's called depreciation. And so the idea is that we need to record our events and transactions in accounting terms. So here's just a diagram here of some possible events and transactions, and pictures there. So if we purchase a computer, then that's an event or a transaction we can convert to a record, an accounting record. Something, if we're in business and we answer the telephone, that's generally something that we can't really convert, and then there's not really an issue of valuing an event, so we generally don't do particular transactions or events such as answering the telephone. That wouldn't be recorded. The third example, if we pay some rent, then generally, we will record that, because rent, we can measure the value of rent, and it's something particularly of value that we'll record. So some events we record, others we don't, and we'll get better over time at recognising which events we record and which we don't. And one of the criteria there is that we examine the effect on our accounting equation. So if there's an event or a transaction, did it affect the assets, the liabilities, the equity, or was there income, or was there an expense? And so if we remember back our definitions of assets, liabilities, equity, income and expenses, then it'll help us in identifying whether a transaction needs to be recorded. Okay, any questions so far? All right, so here's an exercise. So which of the following events result in an accounting transaction so this is a business for called Clothing Limited. So, number one, we have Clothing hired a new store manager, and the manager starts work next month. So, so does anyone have any idea whether we need to record that? No, because it largely involves a future event. So, because it's next month here. So, if someone starts work, then we will maybe be liable for their wages, or so we might record that. But if it's a future event, we wouldn't do that. We've got number two, the founder of Clothing Limited is also a major shareholder, purchased additional stock or shares in another company. So would we record that? Yeah, we might think yes at first glance, but no, I think the answer will be no, because it doesn't actually relate to the business. So, because it's a transaction that doesn't affect this particular accounting entity. So, the founder is actually doing a transaction involving another business. The second reason we might not record that is the fact that if there's just a share transaction, there's really, for the business, if it's a company that issues shares, then the company is not really concerned about the buyers and sellers of shares that's been issued on, say, on a stock exchange, because there's a change in ownership there, but it doesn't affect the assets, liabilities, equity, or income or expenses of the company. So generally, exchanges of shares wouldn't be recorded. Number three, Clothing Limited borrowed $230,000 from a local bank. Would we record that? Yes, we would, because the $230 cash is an asset, and we incur a liability, a loan, a borrowing or loan from a bank. So we'd record number three. Number four, clothing purchase, or the business purchased a sewing machine, which is paid for by signing a note payable. So this is just, we didn't pay cash, so we just owe the money. So would we record four? Yeah, we probably would, because the sewing machine would be an asset, and we'd acquire its property, plant, equipment, and we'd also incur a liability in doing that. So we'd record four. Number five, Clothing issued 10,000 shares to a private investor who is also a car business owner in return for a new delivery truck. So would we record that? Yeah, we would. It's a little bit tricky or different from the normal situation. So there's an issue of shares, share capital, so that's an equity account. And then instead of getting cash for that, we're getting an asset. So we're the delivery truck. So we'd record the increase in assets and an increase in share capital. Now, number six was two investors in Clothing Limited sold their stock to another investor. So would we record six? No, we wouldn't. It's similar to what I said before, because there's no real change in assets, liabilities, or equity, or income, or expenses. There's just a change in the underlying ownership of the shares in the business. So we wouldn't need to record that. If we had someone managing the issued shares, then we'd have a register of the owners of the shares, and that would change, but that wouldn't involve an accounting transaction the business would need to record. Then number seven, Clothing ordered some fabric to be delivered next week. So would we record seven? Yeah, we probably would, because even though it's to be delivered next week, we've entered an agreement or a contract to acquire an asset, and we've incurred a liability. So we'd probably recognise the liability being the amount of money we have to pay for the purchase, and we'd probably confidently record an increase in that fabric. If it could be an asset or an inventory, depending on the business. Now, trying to think. Yeah, we probably would record that, even though it hasn't been delivered. Number eight, Clothing Limited lent $250,000 to a member of the board of directors. So, would we record that? We probably would. That's actually fairly tricky, especially for our second week here. We've lent some cash, so we've got a change in our cash assets, so we'd have to record a decrease in cash, and then there's a debt or owed to the company by one of our directors, so we'd record that as a debt. And if we're producing financial statements too, it's probably a related party transaction and would have to be disclosed also in the financial reports. So that's something outside our course, but certainly whether a business or a company's doing transactions with related parties, being say a director or an owner, then they also have to be declared as well. Okay, any questions about our lecture exercise? Okay, let's move on and let's get a bit of practice at classifying our accounts. So here's a number of accounts here. So which of the above accounts, so asset, liability, equity, it's revenue or expense. Sometimes it's used as revenue here. Sometimes income, generally I use income because income is a little bit broader than revenue, because income includes revenues and gains. Anyway, so let's have a look at our list. Accounts payable, what do we think that is? It's liability, so that's an amount we owe. Accounts receivable, it's an asset, it's an amount of money that we're owed. Advertising, it's an expense. Appraisal fee revenue, yes, it's revenue. Building, yeah, building's an asset. Cash at bank is also an asset. Commission revenue, it's revenue. Commission payable, yes, it's a liability. Depreciation. Depreciation, we haven't covered this actually, it's an expense. So we'll cover the depreciation a bit later on in the course, and it's actually an expense. Electricity expense, at the bottom here, it's an expense, as the title suggests. Expenses payable, it's a liability. So even though it's got the word expenses in the title there, it's a payable, so it's actually a liability. Insurance expense is an expense. Interest expense, interest payable, it's a liability. Land is an asset, correct. Mortgage payable, it's a liability. Office equipment, yes, it's an asset. Office supplies expense, it's an expense. Office supplies inventory, it's an asset, yes, inventory is an asset. Prepayments, yes, prepayments are generally assets. Then retained profits. Yes, sorry, question here.
So what would be the prepayments? So is that the prepayments you're going to receive or the prepayments?
That's a good question. We'll actually cover, we'll cover this next week when we look at adjusting entries. But prepayment, what we mean by that is that we've paid an amount of money for an expense we're about to incur. So example is prepaid rent. So, or we could prepay insurance. So generally, if we're renting an apartment or a house, and the owner will require the money at the start of the month, then we treat that as an asset because it carries economic benefits with it, because it enables us to live in the apartment or the building. And then so initially it's treated as an asset, and then as the month expires, we consume that asset and treat the portion consumed as an expense. So prepayments on their own are expenses. Okay. Any other questions? Yes.
Is it possible for the customer, because the customer has paid the money to the business as well, so can the prepayment classify to the receivable as well?
Yes, so it depends on the point of view. So whose point of view are we talking about, the business or if it's a customer? Then from the customer's point of view, yeah, they have a prepayment, if they've paid an amount of money in advance. From the business point of view, it's money that it's a prepayment of money, and it's unearned revenue, which is a liability.
So normally now, like for example, in our exam, where prepayment, we've got prepayment, so normally that will be the business.
Yeah, so generally the question should be clear on whose perspective we're looking from. So generally, most of the time when we're teaching accounting here, we'll be looking from a business perspective, or a business perspective really. So it's an accounting entity. Could be a company, could be an individual, could be a partnership. So yeah, and so that's the perspective we're looking from. But it's a good point, because in some transactions we've got two parties involved, so we could look at it from two different points of view. And so the accounting treatment will be different depending on which party or which business we're looking from. Yeah. Okay. Any other questions? So where are we up to? Where were we up to? Retained profits. So we've got salaries payable. It's a liability. Salary expense is an expense. Service fee revenue is revenue. Share capital is equity. That's right. Commission expense. Telephone expense is another expense. Unearned appraisal fee. That's pretty tricky. That's actually a liability. So unearned appraisal fee, or the other simpler title is unearned revenue. So this is where we've received money in the business before we've provided goods or services in exchange for the money. And so until we do the goods or provide the services, and we hold the money in advance, it's in advance. So we'll treat it as a liability until we actually do the work or provide the goods. An example I think I might have mentioned last week is the airline. So when we we book a trip on a plane with the airline, we have to pay the money straight away. And so the airline treats our money as a liability because they haven't provided the plane and the flight yet. And so when we fly, then they provide the service, and then they treat that money as revenue when they fly us. But until that time, they holding our money in advance, and so it's unearned. Where are we? It's unearned revenue. So for the airline, so it's actually a liability. Okay, next one was sales. Actually, that's a bit tricky because sales is generally short for sales revenue. So it'd be revenue where you see sales. And cost of goods sold. So yes, this is an expense. So this is where we sell goods, and then basically the goods sold, which is inventory, leaves the store, so we've got an outflow of economic benefits, and that matches expense. That's treated as an expense. So we've got all the answers there. No. So any questions on any of those? Yes. Accumulated depreciation. We'll cover that a bit later on. That's a contra asset, so it's a special type of account. So we'll cover depreciation a bit later in the course. And that's where we use up the economic benefits in an asset, and then we create an account that recognises that. The depreciation expense recognises the consumption of benefits in a particular accounting period, and the accumulated depreciation is the consumption of benefits during the life of the asset, potentially over a number of periods. And it's called a contra asset, and it's attached to the asset account. Okay, any other questions? Okay, let's move on. So we've just looked at an account and identified some transactions and what accounts they affect. So the transaction analysis is, we use our basic accounting equation. So one way the simplest way is we can identify the effect of a transaction on our accounting equation, assets equals liabilities plus equity. And the golden rule is that the equation always balances. So we always we generally identify two accounts, and our equation will always equal, no matter what. And we've got some there's a few examples there of various business documents. So one of the other issues, just to help us, is that when there's a transaction, there's often some evidence of the transaction. There'll be an invoice, a receipt, or there'll be some electronic record, and so that helps us, of course, for maintaining our records and being able to verify transactions. And also at tax time, we will also have the various documents and evidence to satisfy, say, the taxation office, the Australian Taxation Office, or the tax authorities that, say, if we're claiming tax deductions for expenses, that we have the evidence there. And also if we're a public company and being audited, we'd also have various records to satisfy the auditors that all the transactions are real and not made up. Okay, so there's some examples of the different accounts. So the different asset items are listed there, and liabilities. And generally what we also do at the start is that, remember when we looked at the definition of income and expenses, the effect of income generally involves an increase in assets or decrease in liabilities, and the net effect is that it increases equity. So what we'll do is where we have an income or revenue amount there, it will have the positive effect on equity. This is called owner's equity. It could be just called equity. And with the definition of an expense is that it often involves, it's an outflow of economic benefits, and involves an increase in an asset, a decrease in an asset, an increase in liabilities, and has the net effect of decreasing equity. So we'll classify our expenses and losses here. And the final new bit here is that when a company pays out money to its investors or shareholders, the dividends get paid are a decrease in equity. They actually get paid out of retained earnings. So where we have a transaction involving dividends, then we'll be deducting that from the equity side of the equation. So if we expand our assets equals liabilities plus equity equation, then we have the assets equals liabilities plus we break down equity into different accounts. That's share capital, our opening retained earnings. We add the revenues there, deduct expenses and deduct any dividends, and our equation should still hold there. So that bottom line is just an expansion of the equity side, depending on the effect of these the transactions, what effect they have on equity. And generally, as I said, income will increase equity and expense will decrease equity. Okay, any question on our equation there? Okay, so let's have a look at some transactions and have a look at the effect. So we issue shares for $10,000 cash. So the two things we need to think about, which accounts are involved in the transaction and what amounts do we record. So where we're issuing shares for $10,000, we'd have an increase in cash assets, $10,000, and we're issuing shares, so our share capital increases $10,000, and that fits under equity there. It's an equity account. Okay? So this is a transaction, and we're just fitting the transaction into our assets equals liabilities plus equity equation. Okay, any questions on that? Okay, let's have a look at the next transaction. So we borrow $5,000 from the ANZ Bank. So which accounts are affected and what amounts are involved? So we're borrowing money, so we've actually got more cash. We assume, of course, we borrow cash from the bank. And then we've incurred a bank loan, a liability. It could be called a borrowing, could be called a debt, but here we're calling it a bank loan. So we've increased an asset, cash, and increased a liability, a bank loan. So our assets go up by $5,000 and our liabilities go up by $5,000 there. And then if we add it to our last transaction, we keep an update of our total assets and total liabilities and total equity, and we'll see that our equation still balances, of course. So our assets here, $15,000 equal the liabilities plus the equity. Okay, any questions on that? Let's have a look at another transaction. We've purchased office equipment for $5,000 cash. So again, which accounts are involved and how much do we record? So in this case, we've got an asset called office equipment. So that fits under assets, office equipment, it's $5,000. And we're assuming here we've paid cash, we've purchased it. So we've deducted $5,000 cash here. So one asset goes down, cash, and another asset, being office equipment, goes up. And so all the action here occurs in the asset side of our equation. One goes up, another goes down. And so we update our equation here, and we'll have less cash and a new asset there. And of course, everything still balances. Okay, any questions on that? Let's have a look at another equation. We've got received $1,200 cash in advance from a customer. Oh, so which accounts and what amounts? So we receive cash. So I'd say we've got a cash asset, an asset in cash, and in advance I'd say we've got some unearned revenue. Let's have a look. So yes, we've got an increase in cash. So we add this to the cash, increase in the cash assets. And this is what I called unearned revenue before, or called revenue received in advance. So that's a liability because we've received money in advance of providing the goods or services. So this is like the airline example I was talking about before. So we've recognised a new liability, the cash received in advance, as revenue received in advance. $1,200 sits in the liabilities, increase in cash. Okay. So this is actually probably expanded from a few slides ago when we looked at the expanded accounting equation. We've got assets equals liabilities, and here we've just again split up the equity accounts, each of these having an effect on equity. Let's look at another transaction. Providing services for $10,000 cash. So we've provided services and received $10,000 cash. So we've got cash, received cash, so it's an asset, received $10,000 cash there. So our cash asset goes up $10,000. And we've recognised some revenue. In this case, we've called it service revenue. So we've got so that sits under equity there. So the effect of income or revenue is to increase equity. In this case, we've put it under, just for convenience, we've put it under retained earnings here. So we've recognised revenue, and that has an effect of increasing equity. So that's how we record the income or revenue using our accounting equation. We'll get when we switch to debits and credits, we'll get a bit more sophisticated. So this is fairly basic. Because we're including a lot of transactions under the equity section here. So, but for the time being, we'll recognise the revenue there. Okay, any questions on that? Yes. Yes. So the appraisal fee in advance is an example of the revenues received in advance. Yeah, the unearned appraisal fee is an example of revenue received in advance. Yeah. Yep. We need to pay back revenue received in advance. Yeah. Potentially, yes. So if we receive money in advance, then we recognise it as a liability, and if we didn't do the job, then yeah, we'd probably we'd actually ought to refund the money. No, because for the time being we're recognising it's enough to recognise the liability, because we're expecting to do the work, or the airline is expecting to provide the plane to fly us home or fly us anywhere we want. So that's when And we'll look at this. And we'll look at this actually next week as a potential adjusting entry. When we receive money in advance, we hold it as a liability. Then when we do the work, we reduce the liability and recognise revenue because we've actually provided goods or services and we've earned income or revenue at the time we do the work or provide the goods. Record it. We'll see next week. We'll actually do another transaction when we do the work. But here, we've just received something in advance. So all we're doing for unearned revenue or revenue received in advance is recognising the cash and recognising the liability for cash received in advance. We'll look at later on when we actually do the work with the transaction for that. Okay. Any other questions? Okay, so that was providing services. So we pay $900 rent in cash. So that looks like a rent expense and some cash. So yes, we've got an increase in our cash asset and we'll recognise an expense. So we've got an outflow of economic benefits from the rent expense we've incurred. So we'll deduct that from equity here. So we reduce an asset and reduce equity by this rent expense. So again, our equation balances. Okay. We pay $600 for insurance in advance in cash. Okay, so we've got the keywords here in advance. So this looks like we're receiving cash in advance. So we've got, this case, we've got we're paying for insurance in advance. So what we've done here is, so what we've done here is we've acquired a prepayment. This is a prepayment. So we've got a prepaid asset. In this case, it's prepaid insurance. So we've acquired a new asset. This is before the insurance starts to operate. So we recognise a prepaid insurance asset and we've paid out cash for it. So we're decreasing the cash asset and increasing or recognising a new prepaid insurance asset. So this will be if we have health insurance and then we ring up the insurance company, Bupa or Medicare, or Medibank rather, and we say we need health insurance, and they say, well, it'll cost you $600. It's probably likely to be much higher than that for most people. So then when we pay the money, at that point in time we recognise a prepaid asset. Then when the insurance period starts to run, we'll see next week that we consume up that asset. Okay, any questions on our prepaid insurance? So we've purchased supplies on credit for $2,500. So we've got a supplies asset. So we've got an asset called supplies. So I'll just go back a step. So supplies is consisting of lots of generally small items of lowish value that we use up in the business. So supplies could be supply of paper, could be supplies of pens, stationery. Could be lots of small things that we use up. Could even be some technology products as well. And so we recognise those as assets, as opposed to inventory. So inventory, often similar items, but the inventory is that we sell them to our customers or clients. So inventory is different from supplies. Supplies are things, assets that we use up in the operation of our business. Inventory are assets that we actually sell to other parties. So in this case, we've purchased supplies on credit. So we'll recognise the supplies asset, and we've got a liability. So generally, when we acquire goods or services and we don't pay cash, we'll recognise an accounts payable liability in that case. So this is it's a broad category of liability account, recognising we've acquired goods or services but haven't paid cash, and we recognise a liability for that. Okay, any questions on supplies? Yes?
So, generally, an asset is, once it becomes consumed, it's an expense.
Yeah, we'll look at this in detail next week, but often that's the case. So some assets, yeah, so that's the general process, yeah. Sometimes assets just are used up straight away, and so we don't do any accounting for them, so we just take them off, record the books, but often we will record an expense for that. Some assets just are exchanged for other assets, such as cash, so we don't use up cash, we just exchange it for another asset, or we might reduce a liability as part of that as well. And we're hiring new employees to begin work in 2 weeks, and the employees will receive a weekly salary of $500. So they're paid $500 every 2 weeks. So here, there's no transaction because it involves a future event. So we've got our employees arriving at a future point in time, and so until they start work, we won't recognise a wages or salary expense because we don't owe them any money until they turn up and start working. So there's no accounting for that, in this case here, a future event. Okay. And we've got payment of a $500 dividend. So here we've paid our dividend. We'll assume it's a cash dividend. We'll see later on when we look at topic 8 or 9, we can actually pay dividends in shares as a share dividend, but here we'll assume it's cash, so we'll decrease the cash and we'll deduct that from on the equity side of our equation, so the dividends generally get paid out of retained earnings. Okay, any questions on that? We've got payment of $4,000 cash for employee salaries. The employees have worked 2 weeks. So we've paid out cash for employee salaries. So we've got salaries expense. So here we've reducing cash by $4,000 and we'll recognise an expense, a salaries expense. Sometimes it's called a wages expense. Okay. So they're the accounting transactions. We've been using our accounting equation for this, and of course, as we've seen all along, our assets always equal our liabilities plus equity. And so if we were to put all those transactions together, this is what it would look like. So this is just summarising those 11. Well, in fact, there were 12 transactions. One of them transactions we didn't record. So we record all those transactions, and that's what it would look like here. So we've got amounts of money, we've got the account names, and we've got lots of plus or minuses. And so one of the things we'll do very shortly is we're going to replace the plus or minuses, because it gets a bit confusing and difficult to manage. We're going to replace the plus or minus with debit or credit, depending on the name of the account. So we'll see that. So we'll follow the same principles, but we're going to get rid of pluses or minuses and use debits and credits instead when we convert to that system. Okay, any questions on our summary there? Yes? We're paying back the bank loan. Okay, if we were to pay back the bank loan, then what we'd do, we'd be decreasing cash, because the bank's going to want cash. We could pay the inventory, but the bank won't want our inventory, it'll want cash. So we'll decrease cash, and then we'll reduce the bank loan liability. Yeah. Okay, any other questions? Okay, so what do we got here? So that was the transactions using our accounting equation. Now we're going to look at debits and credits, and we're going to do a very similar thing, except we're going to use debits and credits. So what the debits and credits, in fact, our accounting equation, we've been doing pretty much the same thing. It's called double entry accounting, because every transaction has two accounts assigned to it. So we've been doing step 1, 2 and 3 so far. We've been looking at the transaction and working out the accounts and how much. Then what we'll now do is introduce a new step, is we'll use a debit or credit, and then will the account increase or decrease. So this is replacing our plus or minuses. We're going to increase or decrease the accounts using or debit or credit. So that's really just the new innovation there, using debits and credits. So what we've got is, by convention, if we have an account, then on the left side it's a debit and on the right side it's a credit. So this is a convention for convenience. So we'll use the left side for debits, right side for credits. Okay, let's look. Now, the nature of the accounts. Again, this is by convention, or what we do is that we think of our accounts as having a natural or normal debit balance or natural or normal credit balance. So each account will have a debit balance or a credit balance generally. And so we've got assets and expenses are debits, and liability, equity, income, revenue and gains are credits. So where we increase one of those accounts, we'll debit an asset and an expense, and where we increase our credit, our liabilities, our equity and income, we'll credit that transaction. So there are lots of different accounts there, and when I was learning this, I only had to remember two things. So generally I remembered that assets and expenses are debits and everything else is a credit. So I only remember two things. Assets and expenses are debits, everything else is a credit, which generally works pretty well. There might be a couple of small exceptions to that, but that's a good rule to start with. Okay, so that's the nature of the accounts. We call assets and expenses debits, and the others are credits. Okay, so generally we go back to this. This is actually a T account. We'll look at this a bit later, also called a ledger account. And so we've got debits on the left, credits on the right. So when we do some transactions, we'll put our debits on the left and our credits on the right, and then we add them up, and then we end up with a balance. So in this case, we've got a balance of $15,000 because we deduct the credits from the debits to have a balance at any point in time. And this is an example where the debits are greater than the credits. So it will have, in this case, a debit balance. So that's at a particular point in time. Could be any point in time. It's often at the end of the financial period, which we'll look at in more detail next week. Okay, any questions so far? So here's an example where the credits are greater than the debits. So we added up our credits, 3,000, 8,000, and debits, and we subtract the debits from the credits, and we have a balance which has got a $1,000 credit balance in this case. This will make a bit more sense a bit later on today when we've worked our way through the journal entries and start looking at ledgers. But in the meantime, generally our accounts will have a debit balance or a credit balance, as in here, or they'll be zero. So there's another possibility of zero balance. Okay, so let's do an exercise here. What's the normal balance for each of these items? So we've got to think, is it an asset, expense, or is it a liability, equity, income account? So accounts receivable, is that a debit or credit? It's an asset, so it'll be have a normal debit balance. Accounts payable, it's a liability, so it'll have a normal credit. We've got inventory. It's an asset, so it'll have a normal debit balance. We got provision for employee entitlements. That's actually pretty tricky, complicated for our purposes. So that's a liability. So it'll have a credit balance. Tax payable is a liability. It'll be a credit. Retained profits. It's an equity account, so it'll be a credit, yes. Interest revenue. It's a credit because it's an income account. Share capital. Share capital is a credit. It's an equity account. Investments. It's an asset, so it'll be debit. Depreciation expense is an expense, so it'll be a debit. Accrued expenses. That's actually pretty tricky because it's actually it's a liability. So despite the use of the word expense, it's actually a liability. And we'll we'll see a bit more detail next week when we accrue liabilities. But it's a general name. It's not used in practice very often, but it recognises that we owe an amount of money. Prepayments. Yes, prepayments are assets, so they have debits, normal debit. Cost of goods sold. Yes, it's an expense, so it has a debit, normal debit balance. And unearned revenue. This is revenue received in advance. Yes, it's a liability, so it has a credit balance. Okay, we got any questions on any of those? Sorry, which one? Investments is an asset, so we haven't covered this in detail, but investments are recognised as assets. So this is an investment that we have. It could be a purchase of shares in another company. Investment, or we could just put money into an investment account in a bank. So that's recognised as an asset. Depreciation expense is an expense, so that'll have a normal debit balance. Accumulated depreciation, which we haven't looked at yet, but that's a contra account, that will normally have a credit balance. So accumulated depreciation will normally have a credit balance. Or has a normal credit balance. Okay, any other questions? Okay. So we've looked at the debits, we've mentioned the debits and credits. So now we've got a rule. Rule is simple, but it's actually an application. It requires us to think a bit. So generally, depending on the nature of the account, a debit is an increase or a decrease. So for accounts with a normal debit nature, we increase the account by using a debit. So instead of the plus or minuses, we use a debit where the account has a normal debit balance, so assets and expenses. So to increase an asset or an expense, we'll use a debit. And to increase an account with a normal credit balance, equity, liability and income, then we'll use a credit to increase the account. So we're just replacing our plus or minuses that we looked at earlier with debits and credits now, depending on the nature of the account. Okay, we'll get a bit of practice at this shortly. Any questions on that? So the starting point is, of course, to recognise what type of account we've got and what's the normal balance of it. So is it a debit or expense, in which case it increases the debit. And the opposite also takes effect. So where we have an asset or expense, then we increase it with a debit, we decrease it with a credit. So we'll decrease an asset or expense with a credit because it has a normal debit balance. And with liabilities, equity and income accounts, we increase them with a credit and we'll decrease them with a debit. Okay, so we've totally replaced our plus and minuses with debits and credits. So let's have a look at it in operation. So there's just on the debit side, on the left side of the screen, we've got our assets and expenses. So we'll increase them with, we've got the blue arrows, increase with a debit, and decrease them in the red or maroon arrows with a credit. And with our accounts with a normal credit balance, they're increased, or using the red arrow with a credit, and they're decreased using the blue arrow there with a debit. Okay. So let's have a look at here's the debit and credit rules. And so that's a summary of what we've just been talking about for the last couple of slides. So where there's an increase or decrease, we'll use a debit or credit depending on the nature of the account. Okay, any questions about that? And of course, because our accounting equation always balance, so our debits and credits are always going to balance as well. That's something we're going to look at in more detail in the next couple of weeks. Okay. So what we've got, the effect of our income or revenues and expenses is that the revenues have an effect of increasing equity. So there's the natural credit there, and expense is a debit, because expenses have an effect of decreasing equity, and equity has a normal credit balance. Okay, so with using our debits and credits now, is that we'll convert our transactions where we put them in the accounting equation. Now we'll assign a debit and credit to them. So we'll have the account name, we'll have the amount, and now there'll be a debit and a credit as well. So we issued shares for $10,000 cash. We looked at this before. So now we're using debits and credits. We debit cash 10,000 by 10,000, and we'll credit the share capital by 10,000. So here, where we switch to debits and credits, we're creating actually what is a journal entry. So this is a journal entry here, and we won't be creating a table like we did before. We'll create a journal instead, and we'll use a debit and credit. So we're going to replace our old system, listing them under assets, by creating this debit and credit, which is a journal entry. So where we borrowed $5,000 from the bank, we debit the asset, the cash asset, and we'll credit the liability, because an asset has a normal debit balance, a liability has a normal credit balance. So we've increased an asset and increased the liability. So there's a debit and credit there. Okay. Next one was we provided services for $10,000 cash. So we receive cash, so we debit cash is the asset, and we recognise some revenue, or income. So income and revenue has a normal credit balance, so we'll credit the revenue in this case. We put it using debits and credits there. So where are we? We continuing? No. So, and we can do the same for all the other 11 or 12 transactions we did before. So that can be, if you want additional practice, you can convert those other earlier transactions using debits and credits. Any questions about those transactions? Okay, so that's a bit of practice with our debits and credits. So what we're going to do is to follow this process. It's part of what we call the accounting cycle. Is that we'll have our transaction, and then we'll put a debit and credit on it, and that will be creating a journal, and then we'll do that for all our transactions. So we'll have a list of journal entries or journal records, and then we'll combine that. So that's what's called journalising the transactions. So what we've just been doing is what's called journalising the transactions, creating a journal entry for a transaction. And then what we'll look at today is we'll combine our journal entries into ledger accounts, and then prepare the trial balance. And then next week we'll do the other steps 5 to 9, so we don't need to worry about that today. One other thing is just, this is more of a housekeeping, it's not so important. So here's just an illustration of the different types of assets, liabilities, equity, revenues, or income and expenses. So this is just if we had a formal set of accounts. And the main new innovation here is that sometimes they get allocated numbers. So if we're running a business, then we might assign numbers to particular account names for our records, and then if we've got a computer and software, then that's often assigning numbers too. So this is more mechanical procedural. It's not so important in understanding accounting. But this is what's called a chart of accounts, where we're listing our different account names and we're assigning it to numbers. So this is what we'll do is we'll create a journal. So a journal is basically just that transaction with a debit and a credit. And generally what we'll do is that we'll create journals as the events occur. So we'll have a record in time from earliest to latest. So our journal entries will be ordered in what's called a chronological or time order. So as we record them, and there was just an illustration there of the. These are the three transactions we've covered. So we issued shares for cash, and then we had debits and credits. And here we borrowed money from the bank. Sorry about the noise. Borrowed money from the bank, and then we purchased office equipment for cash. I'll just give you. Generally, what we'll have a date, and then we'll have a transaction with a debit and a credit, and then an amount of money. So this is just the general format for our debits and credits for journal entries. So this is just an alternative form. So what I usually do is I usually use this because I find this simpler and easier. So and by convention we put the debits above the credits. What the slide we just had up had the accounts, and they had the debits in the left column and the credits in the right column. It's also an alternative way to create a journal entry. I use this format as well because I prefer that. I find it a bit easier to write. So that's just the format, the presentation of the journal entry. There's two alternatives you can use. So the one here for what's called the general journal transaction is that it's got the date here, it's got the account names, and then it's got debits and credits in columns here. So instead of putting debits and credits here, they're done in the columns. So it's just a formatting or the presentation issue. And the other thing here's a posting reference. So those numbers would come from the chart of accounts. This is actually not so important for our purposes, but just to be aware that there's a reference here, just relates to the number of the account in our chart of accounts. But it's not so important. Okay, so that's just introducing the idea of a journal. It's a record in time of all our transactions using debits and credits. Okay, so that's what I've covered. And here, and the other is that there's sometimes the journal entries, or in theory they should have a narration, so an explanation of what went on. So this is a brief explanation of the transaction. Sometimes it's called a narration. So here we issue shares for cash. Here we borrow money from a bank. Here we purchase office equipment for cash. So what it does is, for our records, we're explaining what happened, because it might be that we have an accountant and the accountant gets sick or resigns, and so for someone else to come in and look at these records, it helps them understand what went on. It'll also help the auditors or anyone else that are coming in and checking the accounts to understand the transactions. Also, if I'm a manager or running the business and I understand some accounting, it'll also help me understand accounts that someone else has created. So these narrations are here underneath the journal entry. Okay, any questions on that? So here's the journal entry with a number of transactions. So the important bits there, we've got a date. So and then we've got the accounts there in the second column. And then we've got the debits and credits here. Debits are on the left, credits on the right. And then we've got a narration here underneath. So that's generally how they look. And generally, and here's an example of just they're all 1st, 2nd or 3rd of October. So they're just in that chronological order. Of course, some businesses are going to have thousands of transactions every day. So if I go to Woolworths, the supermarket, and you look at all the number of people scanning items, they're going to have tens of thousands of transactions every day. So they're going to have a very long list of journal items there. Okay, let's have a break for 5 minutes, and then we'll continue on working through our journals. Actually, what it recognises is that we haven't paid the expense. We haven't paid the expense, so I'll do this after the break. Now it's actually where I haven't paid an expense. So if I have, if I owe wages, I'll recognise the wages expense. So if I owe if you're working for me, I owe you money for wages, then I'll debit a wages expense. Well, expenses are different, but if I pay you in cash, I'll credit that. If I pay you cash, but if I don't pay you, I still have an expense. But I recognise the liability because I haven't paid you. So that's a bit complicated for our first week. So it's a liability. That's just a format. So it's a presentation. It's a presentation. That's it. Okay, so that's here we are with the journal entry. I have a couple of questions during the break about accrued expenses, and it is a bit complicated, so I'll just give you a bit more explanation about an accrued expense. We'll cover this next week in a bit more detail because it's an example of an adjusting entry, but I'll give you an introduction to it now. Actually, someone asked me about this. So this, just to repeat, this is just two ways to present a journal entry. The debit and credit can go at the top of the column on the left and right, or the debit and credit can go on the side of the account. And this is the way I prefer. I think it's a bit quicker and a bit easier to write out, just a format. Other issue is that this is a journal entry for I pay cash for a wages expense. We saw a similar transaction earlier today, and that's the journal entry for it. I pay, you're my employees, and I pay you cash. So I'll credit cash. Cash has a normal debit balance, it's an asset. I'll credit it. And sorry, I've got some messy handwriting too, so let me know if you can't read any of my handwriting. So this is wages. And I'll recognise a wages expense when I pay cash. Now it's possible that I might not pay you cash, but I might recognise that I owe you money. So similarly, where I recognise an expense, but I don't pay you yet because it's not payday. So for example, I might only pay you once a fortnight or once a month in some cases. So where I might recognise a wages expense but I don't pay you, the journal entry would involve the same wages expense, that's expense, and it would recognising a liability called an accrued expense. The other name for this would be wages payable. So this is just the other name for this. It's actually a better name because provides more information. So where I recognise that I owe you money, but it's not payday, so I'm not going to pay you. But I do a journal entry to recognise the wages I owe you. So I'll credit wages payable, and there are various classes of liabilities. There can be it could be salaries payable, it could be another type of payable, and there's a more general name for the account called accrued expense. Accrued expense is used as an example when we're teaching debits and credits, but you won't see it in practice because it doesn't provide information about what type of debt or liability it is. It just says it's an accrued expense, and I'm just using an example of, say, wages. At the moment, it could be electricity expense, could be a rent expense, could be any other expense, and I can use where I haven't paid the expense, but I recognise an expense and recognise a matching liability, wages payable. So that'd be the journal entry where I recognise wages expense, but I haven't paid it, but I'll recognise a matching liability for it called wages payable, or you can call it accrued expense. That's the journal entry there. Okay, any questions on that? Let's go back to our slides. So that was the journal entry with our list of journals. So we've got, and there are the other transactions. So I'll run through. We've got sufficient time. What I might do now, we've got time for this, is that I'll just see any value in this. Okay, what I'll do is that I'll go to the assets, the accounting equation, the transaction, then I'll convert it to the general journal, to debits and credits. So I'll do that. Okay, so let's go to, so what I'll do now is I'll write out in detail these transactions. So we've got the so remember we had the cash we issued cash for share capital. So in this case, this print's quite small. So we had, I can't remember the amount now. So the money here might be $10,000. So we had $10,000 cash, share capital of 10,000. So that's how it'll look here now using our transaction analysis. And then if I convert it using debits and credits, the journal entry, I'd debit cash, I'd credit share capital, 10,000. That's a journal entry for the issue of shares for cash. So look at the next transaction. Okay, I'll borrow $5,000 cash bank loan. So $5,000. So where I borrow money from a bank. So the second one was I borrow money from a bank, so I increase. So I have cash 5,000, have a bank loan 5,000. It's a liability. Then if I convert that to a journal entry, I'll debit cash for 5,000 and I'll credit a bank loan for 5,000. So that's the same transaction here in a journal entry. There's also a date. I'm just leaving out the date here, but there'll be a date underneath here as well. Okay, so that's the second transaction. Next one is purchase office equipment for cash. So we purchase office equipment for cash. So we have, I'll have office equipment. So we have office equipment, I think it's $5,000 there. So this is an increase and we pay cash. So we have a decrease. So this is the purchase of office equipment for cash. The whole transaction occurs in the asset section. We have an increase in one asset, office equipment, a decrease in another asset, cash. And then to convert that into a journal entry, so we credit cash because we're decreasing cash. Cash has a normal debit balance, so it'll also be 5,000. And we'll debit office equipment because that's an asset and it's increased. Okay, so that's our third transaction there. Any questions on that? So our next one is, we've received $1,200 in advance cash. So we received $1,200 in advance. So this is where we receive $1,200 in advance. We get cash of $1,200. It's an increase. And then we receive I'll try and get the correct title. What do we got? Revenue received in advance, yeah. So what we've got here is a liability. So we receive cash in advance before we provide the revenue, so we have a cash increasing 1,200. We have a liability, revenue received in advance, increasing. And the journal entry for this will be we debit cash 1,200 and we credit the liability revenue received in advance. Okay, so that's the journal entry where we receive cash in advance. We've debit the asset, cash, and we'll create a new liability and credit that liability. Okay. Let's have a look at our next transaction. So we do some work, service revenue, $10,000 cash. So here we've done some work, earn revenue of $10,000. So we receive cash of $10,000 and we've got some revenue. I think it's called service revenue. So we do some work and we earn revenue of $10,000. I think it was called service revenue. So revenue fits under our equity because it has the effect of increasing equity. And then if we convert that to our debits and credits, we receive cash, we debit cash by $10,000. And we'll credit service revenue. Okay, so revenue has a normal credit balance, so we credit service revenue where we earn revenue. Okay. So that was there. Let's look at the next slide. So we're up to, we pay cash for office rent. So we're recognising a rent expense and we're paying it. So we've recognised a rent expense. So what was the amount? I can't remember. It was $900. So we deduct $900. So sometimes I use an arrow down. It's a minus sign. So we have a decrease in cash. And then we've got a rent expense of $900 there. So that's the payment of our rent, and convert that to debits and credits. So we've got cash. We credit cash because there's a decrease in cash, and we're recognising a rent expense. So expenses have a normal debit balance. Okay. Let's have a look at our next one. We purchase supplies on account. Purchase supplies on account. Okay. Oh, actually, no, there was a prepaid insurance. I just skipped one. So, prepaid insurance. So, next transaction. So we recognise a prepaid insurance asset, and we'll also have cash here as well. Just check the amount. 600. So the prepaid insurance, that's plus. That's an increase in the asset, and then we'll minus 600. It's a decrease in cash. So here's a we acquire a new asset, so we pay for insurance, and it's in advance before the insurance period begins. So we'll recognise an asset as prepaid insurance, and we pay out cash there, and then we'll credit cash 600 and prepaid insurance 600. There is the journal entry for that. Okay, everyone's good with that? Let's have a look at the next journal entry. So we purchase advertising supplies on account. Advertising supplies on account. So next transaction was, so we had some advertising supplies. So this is supplies. It's a supplies as an asset. And how much? 2,500. So 2,500. And we didn't pay cash for it, so we'll recognise an accounts payable. So this is a fairly common accounts payable. This is a liability. And we'll have, I'll call it add supplies, is an asset. And accounts payable is a liability. So the journal entry for that is we'll debit add supplies or advertising supplies, credit accounts payable. Okay, that's good with that. We're paying dividends for cash, 500. So we're paying a cash dividend. So I can't remember how much. I'll just call it. It's 500. So cash is 500. This is a decrease, and we're paying dividends. And dividends get paid out of retained earnings. So we're paying a cash dividend. We'll credit cash 500, and this is a simplification. We'll look at this in more detail in about week 8, but I'll call it dividends for the time being. So we'll debit dividends, credit cash. I've simplified the accounting for dividends here because we're just teaching the effect of paying a dividend is to reduce equity and retained earnings. So this is actually not strictly correct, but we'll look at the correct journal entries for dividends in a few weeks' time. And we credit cash 500. Okay. And the last one I think we're up to, or on the slide. We recognise this. We paid cash for salaries expense. 4,000. So we've paid cash of 5,000. It's down, and we had a salaries expense. Uh, 5,000. And the journal entry for that is we'll recognise a salaries expense of 5,000, and we'll credit cash. Cash goes down. So that's a journal entry for the payment of a salaries expense. Okay. Now, if I used the example before, where if I didn't pay if I didn't pay cash for the salaries expense, then say if I didn't pay cash for salaries expense, I could recognise the salaries payable. We'll look at this next week in more detail. So the alternative journal entry where if I recognise the salaries expense but I didn't pay cash, I recognise the liability. I would create a liability here. So the liabilities go up, and this has the effect of reducing equity. And so I would have a salaries payable liability and recognising a salaries expense. And the journal entry would be I'd have a salaries payable liability matching the salaries expense. And this is also known as an accrued expense. So we'll look at this next week in more detail when we look at adjusting entries. Yes?
Is that normally the case for employees that are paying monthly? Will they receive that e-taxi revenue from the clients before they pay their staff?
No, it's a good question. The answer is, we'll look at this next week, and the answer is that when we get to the end of our financial period, usually at the end of our financial period, we need to actually update all our accounts, and we'll recognise expenses even though they haven't been paid because we're providing up-to-date information. So what we do, and because say our end of our financial period, say is the will be 30th of June, but 30th of June this year might fall on a Sunday, and Sunday's not a payday. So on the 30th of June, we won't pay our cash and reduce all our salaries expense to zero. What we'll do is, or the salaries payable to zero, we'll do this journal entry, and then because it'll update our accounts, and so we use that in that case. Then when it comes to payday, what we'll do is we'll credit cash, and we'll look at this next week, and we'll reverse this credit. We'll reverse this salaries payable with a debit, and we'll pay out the cash. So I might as well do. I've been talking about it so much. So what we'll do is that we'll look at this next week. So the journal entry I'll do is that I'll extinguish this salaries payable liability with a debit, and when I pay out the cash on payday, which will be on payday. If payday's Thursday, it'll be the following Thursday at a later point in time. So we'll actually do that journal entry next week when we do it. So this is an example of adjusting entry, which we will cover next week. Any other questions? Actually, what your question does relate to, of course, and when we study cash and assets, is that there's sometimes cash flow problems for businesses, and so it's pretty serious. If you can't pay your employees or your staff because you don't have the cash, that's a really serious problem. Because you really can't expect people to turn up to work if they're not being paid cash. And people often relying on their cash salary to pay their own expenses and buy food and whatnot. Okay, any questions? Any more questions? Let's go back to... So what I've done is that for our purposes, I've gone back and done the transaction analysis using our accounting equation and converted it to a journal entry. So let's get back to the slides. So that was the process of the journal entry, and I've also written out the transaction using our assets equals liabilities plus equity. So that's the process of what's called writing a journal entry, creating journals using debits and credits. Now what we have is what we call ledger accounts. So the next step is that so we've got transactions, and then we've created debits and credits in time order, so from the 1st of January all the way down to 30th of June or 31st of December. Now the question is, if we go back to last week, well, why are we doing this anyway? So why do we bother with accounting? And we remember back to last week, one of the important things we need to do is we need to provide useful information for decision making. So we don't want some of them. So the journal entry information is good, but if I go back to the journal entry, now does that help me make decisions? It could, but it's going to be difficult, because if I'm Woolworths, I've got 10 million of these, okay? I've got 10 million journal entries from everybody or that been to Woolworths during the financial year. So I've got 500,000 purchased bread and milk, and $200,000 buy tinned cans of food, but that's not so useful. So what we're going to do is that we go to process of creating ledger accounts. So each of these accounts, asset, so cash, accounts receivable, bank loan, accounts payable, retained earnings, share capital, they all have their own ledger. So we create a ledger for all of them. And there's some example there for the individual assets, individual liabilities, individual equity. They have their own ledger. And so we transfer the information from the journal into the ledgers for the individual accounts. And then we add them all up for the period. So we'll add up thousands of transactions. And of course, we'll have debits and we'll have credits, because some of the accounts were for cash. We receive cash, so we debit cash. We paid out cash, we credit cash. So in the cash, we'll have hundreds or thousands of debits, hundreds of thousands of credits, and then we'll have a balance at the end of it all. And so that'll be our ending or closing balance for that ledger account. So the steps we have is so the process is called posting. So we take the information from the journal entry and we put it into the ledger for that account. So for every journal, we'll do it twice. We have two accounts, so we'll post the information from the debit to the account on the debit side. We'll post the information on the credit side to that account here on its credit side. So we post the information from our journals into the ledgers. And so we record, so we pay attention, of course, is it a debit or a credit, and how much it was, and of course which account. And we do this for every journal entry. And then, so let's have a look at an example of this. So we do some work worth $263,000, and we're owed money. The client hasn't paid us cash yet, but we'll recognise the revenue. So we've got a journal entry there where we haven't been paid for our work, but we'll recognise an accounts receivable asset. And so we debit accounts receivable as the asset. We'll recognise the revenue, so we credit the revenue, in this case sales revenue. And then what we'll do is that we'll post this information from the journal into our ledgers. So we have two ledgers here, accounts receivable ledger, and we've got a sales revenue ledger. So every account has its own ledger. And so debit accounts receivable, 263, so debit side is on the left, and so we debit here 263,000 on the debit side of accounts receivable. And one thing to pay attention to is that we provide the corresponding account. In the case of accounts receivable, that's the account there, it's at the top of the ledger. So sometimes this is called a T ledger because it usually follows the T shape, so we have a T ledger, so it's accounts receivable, it's a debit of 263, goes on the debit side there, 263. Now this here, it just tells us what was on the other side of the account. In this case it was sales revenue. So we'll write sales revenue there, and of course we write the date. And so this is the other corresponding account. It just provides us with more information, because what we'll see is that it's possible to make mistakes. So if we're doing this by hand, and if we're at Woolworths, we might do this 10, 100,000 times. And so we might make a mistake. So this can help us trace back where we might have made a mistake, or provides us with information. And the sales revenue, it's a credit, so it goes on the credit side, sales revenue, and there's the amount there, and that's the date. And the corresponding account, the matching or opposite account, was accounts receivable, so we write that in here. It just tells us where it came from. So that's the process, and so we've done one journal entry. So we do that for every journal entry, and we do that for the whole period of time. So any questions on that, the example of posting from a journal entry to a ledger? Okay, so what have we got here? So we've got an example. Oh, okay, so what we've got here is we've stripped, the first example is just stripped down, where we got cash. Here we've just put the debits and credits, so all the debits go on the left side, credits on the right side. So that's just the basic information, the amounts of money. So this has involved 9 journal entries. So we have 9 journal entries involving cash. 4 of them we debited cash, 5 of them we credited cash. So we just post the numbers in here, and that's what it looks like, the T ledger for cash. Now here's where we add more information. So we put the dates. So this is, of course, the correct way, because to help us understand where it came from, we need the dates and we need the corresponding accounts. So we put the dates next to each transaction and the amount there on the side. And this is the opposite or corresponding account. And again, here are the dates, corresponding account, and the amounts. So that's how your T ledger should look. Okay. And this involves posting 9 times from 9 journal entries into our cash account. Okay, any questions on that? So what we do is the process of, when we create our ledgers, we do what's called balance. So we balance it up, and then what we do is that we add up all the debits and we add up all the credits, and we have a balance at the end. And so we have 2 types of accounts as well. We have asset, liability and equity accounts, and we have income and expense accounts. And what we're interested in, of course, is adding up all the debits and all the debits on the left for you and all the credits on the right. And then we have a closing balance. And then that actually closing balance goes into our what's called a trial balance, which we'll look at shortly. So there's a process called balancing the accounts. Yeah, so once we transfer all the journal information into the ledger accounts, we have to what's called balance the accounts. So we have two sort of processes. So for our accounts, our ledger accounts, we have what's called permanent accounts and we have temporary accounts. So our permanent accounts are our asset accounts, liability and equity accounts. So they generally always have a balance. If it's not zero, it'll be basically an amount of money, at the end of the period. And then that amount gets transferred to the beginning of the next period. So they always have if they're not zero, they will always be have a number basically from one period to the next. So the total is transferred between periods. In contrast, we have what's called permanent accounts, and they're income and expense accounts. Now, in accounting terms, what we do is we reduce them to zero at the end of the period. We'll total them all up. So we'll add up all the income, we'll add up all the expenses, and then we'll use those in our income statement. But in accounting terms, we reduce them to zero, and we'll look at this process next week. It's called closing. We'll do closing entries. Now, the reason for the difference between permanent accounts and temporary accounts is that where we have assets, liabilities and equity, it's a position, it's a financial position, and we always know in a point in time what our financial position is. Because those accounts are permanent, they always have a balance where they exist. With income and expense accounts, they form our income statement. So when we produce an income statement, we're interested in the performance over a period of time. And we measure that by starting at zero at the beginning of every period. Because if we want to work out our profit, we add up all the income for the period and all the expenses and deduct expenses from income. And that gives us a net profit or loss. So that makes more sense when all the accounts start at zero. So to measure performance. Because if I started with another number, I'd be mixing up the income and expenses from last year or from another period. So the accounts are treated differently, and so the income statement accounts, income and expenses, are called temporary accounts. And the process is we'll look at next week where they're reduced to zero, and we'll do there'll be journal entries to help us do that. So that's a bit of background about how we treat the accounts differently, and that's why when we look at T ledgers, their asset, liabilities, and equity all usually have an opening balance and a closing balance. So the opening balance will be the balance that we carried over from the prior period, whereas income and expense accounts always start at zero. So there's no opening balance, or if there is, it's zero. So let's have a look at the balance in the account. So this is an asset account, and this is complicated. So what they have is that, now here's an assumption, we just started business for the month of October, so we have these transactions, and then what we have is basically a closing balance of 15,200. It's a little bit more complicated, so what this is so if I have a T ledger for cash, so I have debits on the left, credits on the right. So often with cash there was a series of transactions. There were a series of transactions, debits and credits, and then we end up with basically a closing balance. I think it was something like 15,200. What was it? It's 15,200, yeah. So this is October. So for the month of October, I used my cash ledger. So this will have a date. There'll be an account, and there'll be an amount of money. The same here. So if I post all the journal entries into cash from the debits and the credits, and then I add them up, and then usually with cash it has a normal debit balance, so I'll have a closing balance on the debit side here of 15,200, and that was October. And then in November I have cash, and then I'll have an opening balance of 15,200. So this is an example on the slide, is where looks like we began business in October, and then we posted all our transactions to cash. We have a closing balance of 15,200, and then for November the opening balance is 15,200. And again, we do the similar process. We'll post all the transactions, debits and credits, and we'll finish with a new closing balance at the end of November. So the example here on the slide, which of course comes from the textbook, it's a little bit more complicated in that what they've done is they've got a closing balance, $15,200 here, and the other way I've written on the slide, which I think is simpler and easier to understand, is just call it a closing balance of 15,200 and write it at the bottom of the debit side in the case of cash. Here they've balanced both sides to 2,600 and then transferred this as the opening balance the next month, 1st of November. So they've just done a little bit of extra accounting in terms of rolling over. It's called process of transferring or rolling over the closing or ending balance in October to November. I actually prefer just writing a closing balance at the end of the month there, and then having an opening balance in the next period there. So this is a little bit more involved, where they just balance out both sides to, in this case, 26,200. Okay, so that's what a ledger looks like, where you've added up posted all the journal entries to the ledger for the month. Okay, any questions on that? Yes. Sorry? Yeah, I don't like that, okay? I don't like that because I think it's a bit confusing. So I prefer what I wrote on the overhead is just to put the closing balance on the same side as the normal balance. Here they've just totaled everything up and reduced it to zero as part of the process. It's just the formatting, really. I actually don't like that when I'm learning this in the first few weeks of accounting of debits and credits. So I prefer the method I did is just to write the closing balance on this side here. What they've done is they've balanced everything out to 2,620 here, so there's a difference. So they've added everything on this side and then deducted. So they've just added 2 extra subtotals there to balance it out. But I actually don't like it because it's confusing. Because we've actually come a long way in the last hour and a half, from all the way from transactions, accounting equation, debits and credits, to posting, to into a ledger. And then this actually is a little bit confusing, the way it's done in the textbook.
So if I should do this one, I should according to write
I would do it this way. So I would write a closing, in the case of cash, the normal balance is debit, so I would have a closing balance here. And then if I opened the ledger for the next month, I would use that as an opening balance here. And so I wouldn't do the addition and subtraction in the slide because it's more work and it's a bit complicated, it's confusing. Yes.
it's the recovery account.
Sorry?
The closing balance. The closing balance is just the sum of the previous account.
Yeah, it's the sum of the debits and the credits for that month, in this case, the month of October.
Yeah, but what about if an account has this closing balance, still not balance? If that's
It has to have a number. If you add up all the debits and all the credits, it has to be a number. So that number will be the closing balance for the period. It gets a little bit more complicated. If it's an asset, liability, or equity account and there's an opening balance, you take the opening balance. In the case of cash, you take the opening balance, add all the debits, and then deduct all the credits. And then you have a new amount, which is pretty rare that you'll have the same closing balance as an opening balance. You might if all the debits and credits equaled each other, but usually what happens is that you'll have different numbers from different transactions. So you'll start with an opening balance, you'll add all the debits, in the case of cash, deduct the credits, and you'll have a new closing balance.
So the closing balance we need to add at the last one?
It'll be the final amount. And then if it's an asset, liability, equity account, the closing balance will become the new opening balance for the next month or next financial period. In the case, as we'll see next week, in the case of income or expenses, we'll reduce that to zero, and we'll always start at zero every month or every period. So, okay, any other questions about our opening and our T ledgers? This will get a bit easier with some practice, so that's why doing the tutorial questions is good. So where are we here? So what the... Let's have a look at... Okay, what I'll do is so this is just an illustration of so I might have I have a series of ledger accounts. So there's, say, 3 assets, and I'll have a closing balance. I'll call this $1, accounts receivable. So I've added all the transactions here, and then, oops, $2, and inventory. So this is the T ledger for cash, and I'm posting all my journal entries here, the debits and the credits. And in this case, I've got a closing balance of $1. And accounts receivable, I do the same thing. I have a closing balance. That's hard to read. I've called it $2. It's $2. And inventory, I've done the same thing. I posted all the debits and credits, and I've got a closing balance of $3. So the next, and I do the same for all my liabilities and all my equity accounts and my income accounts and all my different expenses. And so they all have, if you like, a closing, or sometimes it's called an ending balance. And then what I do is that I take all my closing balances for those accounts, and I transfer these closing balances into a trial balance. So I'll have cash, accounts receivable, and inventory. $1, $2 and $3. So the process of creating the trial balance is I just take the closing entries from my ledgers for all my accounts, and I put them generally in a sort of a line, an order there, and then the trial balance will tell me what's the closing balance of all my accounts. So the trial balance is a list of the accounts and their balances. In this, the illustration we'll be looking at is just at the end of the month. End of a month could be it's usually at the end of a financial period, say 6 months or 12 months. And then, of course, the trial balance has the closing balances, and also has whether it's a debit or credit. And what I'll find is that all the debits and credits will equal each other, because remember when we did the journal entries, I always had debit and a credit, and then if I transfer all those into their individual accounts and I end up with closing balances, I still should have the same number of debits and credits. And then, so posting all the closing entries into my trial balance, if I've done it correctly, I will have the same inequality of debits and credits in the trial balance. And so the trial balance involves writing out the account numbers and whether it's a debit or credit, and the amount, of course. And then a trial balance, I create 2 columns for debits and credits. So here's an illustration of the trial balance. Is that we've got, there's just the account number, the account names there. And so I think by convention, the account names that are listed in assets, liabilities, equity, then income, and then expenses. So we've got assets here, then we've got liabilities, we've got equity, then we've got revenue and expenses there. And so we've got debits and credits. So all those closing balances, if they're a debit, they're in the left column. If they're a credit, they're on the right column there. And then we add them all up, all the debits and all the credits should equal each other. So this is fairly mechanical in the sense of once I have my closing balances in my ledgers, I just take that number and I put it in the debit or credit side and write out the name of the account. And generally also, don't forget, this is important, is that if I'm creating a trial balance, I need to put the name of the accounting entity, the name of the business at the top, and I need to say what it is. It's not an income statement, it's not a balance sheet, it's a trial balance. So I'll have the name there, and I'll have it at a point in time. It's generally, in this case, it's the end of the month. It's often at the end of the financial period, 30th of June or 31st of December in Australia. That's the end of the financial period. And of course, if I've transferred all the information correctly from the journal entries into the ledgers, and then added them all up correctly and transferred the closing balances from the ledgers into the trial balance, my debits and credits should all equal, should be the same there. Okay, any questions on that trial balance, that example there? And so the information I've got now in my trial balance is a bit more useful than the journal entries I had for every day, right? So now we're in a position where we're creating more information, more useful information. So I can look at the end of October here and see what are the balances of all my accounts and match it up. So that now we're getting some more useful information. Now, one of the issues is for the trial balance, actually we're at the time. Let's have a break for a few minutes, and then we'll finish off the slides, and then I'll work through an exercise next hour. So we'll have just a brief break for a few minutes. Okay. Now we've got our trial balance here. Now I'll go back a step. I had a question during the break, which is a good question. So, where's Wong? So here's our cash ledger account with Wong Proprietary Limited. So I'll just go back to this. Now, I'll illustrate how we get that information. Or I can work backwards. So to illustrate how I get that cash ledger account, I'll work backwards. So I'll look at that T ledger and I'll work out what were the journal entries that enabled me to create that T ledger. So in the case of Wong, I've done the first few. So let's have a look at, for Wong here, I'll be interested in, first thing I'm interested in, of course, the dates. So October the 1st, we've got increasing, so this is a debit of cash. On the left side's debit. So cash increased $10,000 on the issue of shares, and then cash increased $5,000 on October the 1st with a bank loan. So I'll work out what were the journal entries that enabled me to do that. So starting with that ledger, October the 1st, I debited cash, 10,000, and the corresponding account was share capital of 10,000, and it was a credit. Now, I know that was a credit. What have we got? Sorry, desktop didn't work. So I'll know. So you remember that cashier debits are on the left. So $10,000 is a debit of cash. And so this corresponding account has to be a credit because debits equals credits. So when I create the journal entries, I debit and I credit, and they're always equal in amount. So here, I debit cash 5,000, and so I know that the bank loan must be a credit, the journal entry that I get that from. So here's the journal entry for the bank loan, October the 1st. Again, we've debited cash on the left side of the ledger, so I know that the bank loan, the corresponding account, same amount, and it has to be a credit. So in fact, it's creating a liability, a bank loan. And if I go back to the T ledger, so I go back to T ledger, and what have I done here? I've got office equipment. So October the 2nd, office equipment. So it's cash. So this is a credit, on the right side's credit. So I've paid out cash. So I've got $5,000 cash has gone out, and the corresponding account is office equipment. So I've credited cash, it's on the right side, so I know that this office equipment must be a debit. So I've credited cash, 5,000, and the office equipment is a debit. So that's the journal entry which underlies this, the T ledger there for Wong cash. So let's have a look at one. Any questions so far? So here's, if I've just started, sorry? Yeah. So if I'm just starting with the information in my T ledger, and I can work out what was the journal entry underlying it. So let's have a look at just one more. So I've got revenue received in advance. So October the 2nd, revenue received in advance. So it's $1,200. So we've debited cash $1,200, and I'll know that to credit revenue received in advance. So I think this is October the 2nd. We debited cash $1,200, and I have to credit and this was revenue received in advance. Okay, so just from the T ledger, I can work out what the journal entries were from the information in the T ledger. And so on, and so, and also for each of these other lines. So on this side, I'm going to debit debit service revenue cash, and I'll credit service revenue, and so that's recognising revenue. In this case, rent expense. This is the credit side, so every time I credit cash, and I will debit rent expense, I will credit cash, debit prepaid insurance asset, credit cash, and I'll debit dividends. So debit dividends. Salaries expense, I'll credit cash and debit salaries expense, and there's the closing balance there. Okay, any questions on that? So let's go back to. So here we are. We're back at the trial balance. So this is actually the end of quite a lengthy process. So what we've done is that we started with our transactions, and then we recorded them we understood them using our assets equals liabilities plus equity. We used debits and credits, and selected the account name and the amount. Then we wrote out the journal entries for all our transactions. Then we transferred all those journal entries into T ledgers, either on the left, the debit side, or the right for the liability side. Then we calculated closing balances and then transferred that into our trial balance here. So when we've carried through all the amounts, the accounts, and our debits and credits, which should equal. Now, sometimes if you did that, you do that, and then sometimes our trial balance doesn't balance. So the question is, what happened and what can we do about it? So if you're asked to do a trial balance in the mid-semester exam, then try and relax. I know it's difficult, but you'll see, my trial balance didn't balance. So usually, to think, well, what can I do about it? So there's a number of things you can try and do. Is if you're asked to do a trial balance, this is in any exercise, like it could be a tutorial problem, to do a trial balance, is to try and re-add the columns up, re-add the debits and credits, see if that's sorted out. If you're using a spreadsheet, you'll know that's correct anyway. Then the other thing to check is, did you post the correct amounts to the correct side of the account? So did my debits from the journal entry, did they always go on the left side of the account, and did my credits always go on the right side? So check those. Check if you actually posted on the same side. That's another thing to do. Then did you balance? If you've posted to the correct side, debit and credit, then the other thing to do is to re-add all the ledger accounts. So take all the debits and all the credits and subtract them from each other, and check that your closing balances are correct. So that's another thing to do. And also go back to the journal entry, and of course check that you wrote the same number. Usually you do, but sometimes people forget a zero. So you might have salary expense $5,000, cash $500, because you forgot a zero. And then when you transfer them to the ledger accounts, you might not notice. So check the original postings have the same amounts as well. Any questions so far on our trial balance and checking for errors? The other thing to do, if I have a difference between my debits and credits there, one other thing to do is to take that difference, it could be either way, divide it by 2, and then divide it by 2 and go back and look in the journal entries, because if I've posted something twice to credits or twice to debits, then it might equal the half of the difference. Say, for example, I had a journal entry where salaries expense cash. I might have posted it both sides to debits. So my debits, I'll debit it twice instead of debit once, credit once. And so if you divide the difference by 2, you might actually go back to the journal entry and see that it equals the amount there. So that's also possible if you've posted it onto the wrong side. Okay, so Now, they're also, with the trial balance, there's sometimes you can't detect the error because you might have done a number of other things which weren't correct. So one of them is you forgot to post one of the journal entries. In the journal entry, you forgot to do it and post it into the ledger, so it won't appear at all. So your trial balance will still balance, but if you forget or omit one of the journal entries, your trial balance won't be correct because you just forgot to actually include that information in the ledger accounts, and therefore the trial balance won't be the same. Sometimes you post it twice, the journal entry is posted twice. If you include it twice, of course, the amounts are going to be different. Sometimes you just missed a zero or wrote another number as well. So the trial balance doesn't detect or pick up some of the errors. The good news is, in practice, is that accounting software will do this for you. So if you're using, when I was self-employed for a number of years, and I used accounting software, and all I had to do was you have to do the journal entries, the debits and credits, and then once you enter all that information, the software will automatically calculate the ledgers for you, the closing balances, and produce a trial balance for you. So in practice, where you've got accounting software, this will be done for you, but for our purposes, it's useful to be able to understand how to produce a trial balance by understanding the role of ledgers and how the information flows from a journal entry into a ledger, into a trial balance. There's some more help. I've just talked about dividing by 2 and look for an account with that balance. So that's where you post it twice to the debit or credit side. Sometimes if you've written the digits, divide by 9. So the difference between debits and credits, sometimes that's because the numbers have been written down 21 instead of 12, or the digits are back to front. So in some cases, that's more likely where you're having to do have a lot of journal entries to write out. The other thing to find an error of your trial balance is to look for the normal balance. So assets have a debit, and assets and expenses have a normal debit balance. So check that the normal balance matches the accounts as well. So if you've got an asset with a credit balance, it's likely to be a mistake somewhere. And also reasonableness. So just check the numbers too. So most of the numbers are equivalent in size. So most of the numbers we've been looking at here are in thousands. So most of the journal entries involve 10,000, 5,000. If my trial balance has $10 billion, then it looks like I've probably made a mistake. All the other account balances are 5,000, 10,000, even 50,000. And one of my accounts has 10 billion, then that's probably a mistake. So let's get some practice at finding an error. Let's have a journal entry with debiting inventory, crediting accounts payable. If the following errors were made, would the trial balance still balance? So what if we did inventory debited $200,000? Okay, so in the case of 1, would our trial balance if we debited inventory $200,000? So we credit accounts payable $20,000. What if we debit inventory not $20,000 but $200,000? Would our trial balance? Anyone guess? Yes or no? No, it wouldn't balance because our debits and credits wouldn't be equal. So I'll write it out. So So this is the first situation is where I've debited inventory 200,000 instead of 20,000. Yeah, you would normally. That's correct. But the question here says, what if I debited inventory 200,000 instead? So that's the question in the slide. It says, what if I just changed the inventory? I made a mistake. So I'm tired, I'm doing these accounts, I've been all day I've been in classes, I go home, I start doing my trial balance, my account exercise, I'm a bit tired, and instead of 20,000 I wrote $200,000. And then I work through the rest of the problem, and my trial balance, is it going to balance or not? Yep. Yep. Yes, correct. Yeah, that's correct. So if I made the same mistake twice, and by writing both 200,000, then it'll still balance, but my trial balance amounts won't be wrong. Well, won't be correct, so it'll be wrong. Yep.
Well, in the exams, do you carry that through account?
Yes. So generally, that's a good question. So generally that'll be done. So it'll depends on the course coordinator. I'm just a humble lecturer, so it'll depend on Acct and depend on the markers. So it's a good question because we have exam viewings, and so if you've done the mid-semester exam and you've made a mistake with the journal entry, then sometimes with the instructions to the markers and the marking guide is to not penalise you a second time, because you'll lose a mark if you've got the wrong journal entry, and therefore because of that your T ledgers will be different from the model answer and your trial balance will be different. So if in most cases the instructions to the markers are that to carry over the effect of the earlier error, and you won't be penalised for having a wrong T ledger accounts and a wrong trial balance. So yeah, so ultimately that'll be for Acct as the course coordinator to determine. So that's why it's actually very important to get your journal entries right, and so then, and also be careful doing this process, transferring information. Yeah, that answers your question. Yeah. Okay, so the question here is, so if I write this down, then that'll mean that I'll have, now assuming I'm in a world where I only have one journal entry for the period. So inventory, I'll have 200,000, and I'll have accounts payable. So accounts payable is 20,000. Okay, so I've just posted those two. I've left out the dates and the corresponding account, so I haven't given myself enough room on that sheet, that A4 sheet, to do that. Okay, so I've posted that information into the T ledgers, and now if I do a trial balance, it'll be the entity name, and there'll be a date as well. So it's a bit sloppy, but anyway. So I'll have an account, will be inventory, and accounts payable. And I'll have debit and credit. So if I transfer, so I've got closing balance is 200,000. I've got a closing, I'll just call it closing balance, 20,000 there. And then if I produce my trial balance, I'll have inventory of 200,000. I'll have accounts payable 20,000. So I'll have a trial balance that doesn't balance. So the answer to the first question is, will it balance? And the answer is no. So so that's this highly simplified case where I just have one journal entry. But assuming I have, if I'm Woolworths supermarkets, I have 50,000 other entries. If they're done correctly, they will all balance out. The debits and credits will all balance out of all the other journal entries if done correctly. And if I make a mistake with one, then it will eventually produce an error in the trial balance. Just one mistake will foul up my trial balance. So that's the answer to the first one. If inventory was debited, would the trial balance still balance? And as we've seen, the answer is no. Okay, so next question is, so starting with this journal entry, we're still the same journal entry. Now, instead of crediting accounts payable 20,000, if I credited cash instead, so I replace accounts payable with cash, would my trial balance still balance? Yes, so correct. So it would still balance. It'd be wrong because my cash would be understated by 20,000 and my accounts payable would be overstated by 20,000 or be understated as well. So it'd be wrong, but it would still balance. Now, what about the third one? So what if I debit inventory, I credit capital. So this is, I'll call this share capital. So if I credit share capital 20,000, would my trial balance still balance? It should. Yeah, I've still got the same number of debits and credits in the system, so it should still balance. So now what if I debited cash instead? This actually question's challenging as to interpret what it means. So what if I debited cash? So so if I debited cash instead, so if I instead of debiting inventory I debited cash, will the trial balance still balance? So I replace inventory with cash. So instead of debiting inventory, I debited cash. Yeah, my trial balance should still balance. Now, if instead, so if I debited cash, but if I made a big mistake and I debited inventory 20,000 and then I debited cash 20,000, so I made a different type of mistake. So instead of crediting accounts payable, if I debited cash instead, would my trial balance still balance? Okay. I've only got two people brave enough to nod their head or shake their head. Anyone else? Okay, let's have a look. So, probably it's easier to explain the error if I actually write it out. The debit inventory 20,000, and this is the correct journal entry. Now, what if instead of this I debited cash 20,000? So that was the journal entry I did. Instead of crediting accounts payable, I debited cash 20,000. So would my trial balance still balance? Told you, I've made a big mistake. I'm very tired. I've been studying accounting all day. I'm exhausted. I know how tiring it is. And I've gone home and I've done this journal entry. Would my trial balance still balance? No, yes, correct. So it wouldn't balance because the effect would be I'd have cash 20,000, I'd have inventory 20,000, and then my trial balance would have cash, would have inventory 20,000. So my trial balance would look like that if I made that mistake. I'd have cash 20,000, inventory 20,000, total debits are 40,000, credits are 0. if I made that mistake. Okay. So let's have a look at, now we've got lecture exercise 4. We've just got enough time to work our way through that. So, okay, let's have a look at lecture exercise 4. That's the last thing we're going to do today. So I'm going to do this now, and probably until we finish in about 15 minutes. But if anyone wants to leave early, you're welcome to do that. As I said last week, I don't mind what time you come in or go. So I'll work through lecture exercise 4 now. We've got 4 transactions, and we're going to, let's see what we're asked to do. We're going to journalise the transactions, we're going to write narrations, the brief explanations, and we're going to post these transactions to the T accounts. So we'll see how we go for time, but we'll do the journal entries first. Okay, so unfortunately, so I'm going to have to take this down and just write out the journal entries. So let's look at the first, our 4 journal entries. September the 1st, we issue shares in exchange for cash. September the 5th, we purchase equipment for $25,000. We pay $10,000 in cash, and we will have an amount owing for the other $15,000. September 25, we paid $7,500 cash on the balance owed for the equipment. So we've paid, and then September the 3rd, we've paid a $1,000 cash dividend. Oh, we've got some cash account numbers there. I'm actually gonna skip the account numbers. It's a bit just for make sure I've got enough time to work through everything. And okay, so let's have a look at the answers for the journal entries, what they should be. So if I'm doing this properly, I'll have the name of the business as Ranch Limited, and usually if I'm creating a journal, it's generally called a general journal, but it's not so important. But we might see later on the course, or you'll see in later courses, we have special journals for certain transactions, but it's probably going outside our course, so we'll call it a general journal. So we've got a date, is September the 1st, and I'm going to do my formatting because I can, and I prefer to write the debits and credits here. So we have a debit of cash and a credit of share capital, and we've got 45,000 there. So that's the first journal entry. We issue shares and receive $45,000 cash. I've omitted the posting references, but you'll see that in the answer, which I'll show up later. Let's have a look. I think I've got. So the second one was purchase equipment for $25,000, paying $10,000 in cash. The balance in there. So September the 5th is I've purchased equipment. Equipment's an asset, so I'm going to debit asset for $25,000. And what the question told me is I paid out cash for $10,000 of it, so I'll credit cash because I'm reducing cash by $10,000. And I'll recognise an accounts payable of $15,000. So I've purchased equipment worth $25,000. I've paid $10,000 cash. I still owe $15,000, and we've called it an accounts pay. It's a liability. This third line of the journal entry there. I forgot the narrations. Issue shares for cash. And we purchase equipment. So part of the payment is cash, and part of the payment, so this is a bit tricky, is on account. So sometimes you'll see these words, on account. So where you see the words on account, that's actually written that's hard to read, on account. Generally what that means is that you haven't paid cash, so it's a shorthand accounting speak or terminology for not paying cash. If I've done something on account, generally means I've not paid cash, so I've acquired goods and services on account, being I didn't pay cash, so I still owe money for the purchase, or yeah, so that's what that terminology generally means. Okay, any questions on those journal entries? Yeah, yes, no. So the next journal entry next transaction rather, was we paid $7,000 cash balance owed for the equipment. So we paid off a bit more of the equipment. So on September the 25th, so we're told that we paid out more cash. So we credit cash when we pay out cash, and we've paid out another $7,500. And what we've done here is we owed $15,000. So I've left off the. So we've reduced our accounts payable liability by $7,000. So we'll debit the accounts payable. So here on the September the 25th, we've paid amount on account. So what we've done here is we owed $15,000 for the equipment here, and we've paid off another $7,500. So I credit cash, and I also reduce the liability. This is a liability of $15,000, and to reduce the liability, I debit the liability. So I debit accounts payable. Reducing a liability. Liabilities have a natural credit balance, and where I debit it, I reduce the liability, $7,500. Okay, all good. Then we've got one more transaction. We've paid a cash dividend. So on September the 30th. So we paid a cash dividend. So we pay out cash, I'll credit cash. And 1,000. And we've got debit dividends here by 1,000. So this is the payment of a dividend. So we credit cash because we're reducing the cash asset by 1,000. So and we've got paid cash dividend is the narration. This debit of dividends is it's a simplified accounting. We'll look at it later on when we look at in more detail the equity section of the balance sheet later on in the course. So don't be too concerned. If you look in the textbook, you'll see dividend accounting gets more complicated, but we'll just keep it simple because we're just getting used to these debits and credits. Okay, any questions on those, on the journal entries? Okay. Now the job we've got to do is we've got to transfer all these journal entries into T ledgers. So now I'll double check that that's what we're asked to do. So yeah, post the transactions to T accounts. So we've got to create the T accounts. So I've got the ledger for cash. So I'll just write debits on the left, credits on the right. So I've got September 1, September the 5th, September 25, September 30. So what I'm going to do now is that what I do is I highlight all the cash transactions. September the 1st was cash, September the 5th was a credit of cash, September the 25th was a credit of cash, and we had a credit of cash here. So if I transfer all these cash journal entries into my cash ledger, it would look like I've got share capital of 45,000. I've got a purchase of equipment of 10,000. I've got reduced the accounts payable liability by 7,500, and I paid dividends of 1,000. So that's the T ledger there for cash. So I basically just transferred those transactions involving cash. There were 4 of them, which are underlined in red, to the T ledger. And I'm not asked to do this, but the other useful thing to do is to work, there'd be a closing balance here as well. So the closing balance will be the 45,000 minus 10,000 minus 7,500 minus 1,000. So that's 18,500. So it's probably around 24,500 off the top of my head. 26,000, thank you. Thank you. So the closing balance, 26,500. So that would be, I wasn't asked to do that in the problem, but I like to do that for completeness. Okay, and so the other process then is to do the T ledgers for the other accounts. So what can I identify? If I go back to my ledgers, I can see I've got a share capital account here for 45. I've got equipment account, the accounts payable here, the accounts payable there as well, and I've got a dividend account here. So I will do the accounts payable. So the accounts payable. So there were 2 transactions involving the accounts payable. There was the purchase of equipment, for which I didn't pay at all, so I had an accounts payable. So September the 5th was equipment. I purchased equipment and created a liability because I didn't pay it all, and that was 15,000. Accounts payable, and then later on in the month I paid off $7,500. So on the September the 25th is I paid out some cash of 7,500, and that would give me a closing balance of 7,500, and it'd be on the credit side. And any questions about those T ledgers? Then if I go to exercise 4, if I look at Here we go. So there's the two ledgers. And so, I'll see if I can expand this. Got view, got zoom, 200. So here's the two ledgers. So we've done the cash, we've just written that out. We've done our accounts payable. And so the other items are the equipment. So the equipment, there was just one transaction. So it's an asset. So on the right side of the account, the equipment there, that the other side was we paid out cash and owed accounts payable on the 5th. Share capital, we issued shares for cash. So share capital, it has a natural credit balance. So it's on the right side. And the corresponding account was cash. And the dividends, we paid out some dividends. So dividends, they're treated similar to an expense because they involve a reduction in equity, reduction of our retained earnings account. So that was on the 30th at the end of the month. So that's the simple posting that one entry to journal entry into the T ledger for dividends. Okay, any questions on that? So that takes us, perfect timing, that's the end of this week. So I'll see you all next week when we'll do adjusting entries and closing entries and the accounting at the end of the financial period. Yep.
Because you show us the diagram, set the nature of what assets and expense should be belong to the debit side.
Yep.
And the liability and equity should be belonging to the
Have
credit side.
a normal credit balance, yep.
Yeah, but like in the last exercise, you already put the liability to the debit side, so that's what I'm confused about.
If I reduce the liability, I'll debit that. But if I increase the liability, it'll be a credit. Okay. So it depends if it's an increase or decrease in the account.
So can I interpret it as the money flew from the credit side to the debit side? Because normally that's why I summarize all these transactions.
No, I don't think that'll help you. You need to just understand to create or increase assets and expenses are debits and liabilities, equity, income, credits. That's all you need to remember. Just remember two things, expenses and assets are debits. And an increase, those will be debit, a decrease will be a credit. And for all the other accounts, I increase with a liability, I decrease with a debit.
Okay. So they can be in the both sides, right?
Yes, of course. Then you increase, one's an increase, one's a decrease. Yes.
Thank you.
Sorry. I throw that all these away. You can have them if you want. No, when you do the two ledgers, you don't have to do that English. You just want the date, the account, and the corresponding form. You don't have to do any of this. Sorry, hello. Sure. Because it's a liability, so it has a natural liability balance. It's a liability, it has a natural liability balance. So I do it on because it's on the same side. Assets on debit side. Yeah. They did it on the textbook slides did, but I like to do it just a simple closing balance on the left.
So maybe we include
Yes, for assets, yeah, and expenses, yeah. decrease equity with an expense, and we decrease assets with a decrease in cash. So it's still balancing, and the effect of an expense is it decreases equity. That's correct, yes. So
So the rounded cases is increase because decrease in
the expense increases, but the effect of the expense is that it decreases equity. That's in the definition we looked at last week.
About this closing balance with
Yeah.
in this decrease account, and this one is also opening balance or
Yeah, I prefer to put this on that side.
this side.
Yeah, I prefer that.
So
I think that's confusing.
that's wrong.
It's not wrong. It's another way to do it, but I like to keep it simple.
So it's also can in this
I prefer to put